What did you see happen in the first quarter of 2025?
Where do I even start? I mean, pretty much we started the year on a more optimistic note. I mean, the rate started to trend down a lot after February, and thankfully it was more so due to just the recessionary fears and overall the job market finally starting to show some signs of weakness, which is what everyone's been waiting for, and for the Feds to feel comfortable eventually, lowering the rates. But then unfortunately right now the tariff situation kind of came about too, which was on the tail end of Q1 and continues to impact us today, but it's just creating a lot more unpredictability in an already very unpredictable environment. But overall, the good news is that we're still at lower levels than we were last year. Like currently they're still averaging, or mortgage rates are still averaging in like the high sixes for a 30-year fixed loan. But once the dust settles for the tariffs, I have a feeling that the rates are going to calm down and drop between 6 to 6.5 is what we're hoping to see it settle at. And if we look in the most recent 2 years, literally the highest point we hit 8.2.
Wow.
And I feel like people forget about that a lot because initially when the rates in 2024, the highest peak was 8.2 and then they dropped all the way to actually 6.2 at one point. And that was before, or, the rate cuts that the Feds did, that didn't really have anything to do with that. It was more so the bigger picture outlook of the economy at the end of the day. And so pretty much what we need is for inflation to subside, which the tariff conversation just complicates when that's going to happen. But we're taking it day by day. And again, on an optimistic note, we're at a much better place than we were not too long ago.
So how are you seeing consumers kind of combat the high interest rate situation?
I would say like right now, I think people are coming to terms with, like, as you and I, I'm sure have both heard a lot, is consumers say, I want to wait for rates to go down. Time and time again, I think in the most recent year especially, it's been a very punch in the face reminder that it could be very fleeting. No one can time anything perfectly. Like at the time, rates dropped to a 6.2, that lasted maybe about a week, and then rates corrected back up to 7 not too long after that. And so I think the consumers who are finding success are recognizing the fact that we need to firmly accept the reality that we can't control when the right home hits the market, when negotiations get done, because literally rates can change day to day, and timing it with when the rates will be the absolute lowest, because that's quite literally impossible. Otherwise we wouldn't be working right now, we'd be on the island somewhere, right? If we could actually predict that correctly. And so I think for the consumers that are able to accept that part of it and literally take everything one step at a time, they're able to find success. Because at the end of the day, no matter what rate you start with, any loan I would recommend to my clients have no prepayment penalties, which means literally you can refinance at any time, you can pay off the loan at any time. So once you're in the property, you at least have peace of mind that your payments aren't going to change for all 30 years. And then, if anything, your payments are going to go down because once you have the home, you're in the home, you can refinance and time that whenever you see fit. You don't have to worry about all the variables we just talked about, right? Home hitting the market, negotiations, all those different things. And so I would say just make sure you're comfortable with the payments right now, and then know that you're going to seize a refinance opportunity in the next couple of years.
Makes sense. So you mentioned something which is, people, I get a lot of that too, that people are trying to time the market and wait for the interest rates to come down. So like, let's say, the news comes out that they're going to do a rate reduction. Like how soon after the rate reduction does your phone start blowing off the hook?
Probably that same day or leading up to the Fed meeting, I get a lot of calls and inquiries. But yeah, like the last 2 Fed meetings that happened where they did cut the federal fund rate, literally the mortgage rates actually went up. And so people don't realize too that the federal fund rate, it's not a direct tie to mortgage rates. They impact more shorter term rates because literally the federal fund rate's referring to an overnight trading rate. Like overnight rate versus a 30-year fixed loan are quite the opposite, right? So they impact more things like credit cards, car loans, and things of that nature. But mortgage rates care a lot more and follow the bond market. And the bond market's watching out for Jerome Powell, what he says in the press conference that follows that meeting and all these different things that could indicate where he feels inflation's going and things like that. And so, unfortunately, depending on literally one statement from Jerome Powell after the fact, whether he cut the rates or not, that's going to impact mortgage rates. And again, it's incredibly unpredictable, right? However, you and I, we're never going to be putting our clients in a position where they're going into a home blindly, right? Like, at the end of the day, one step at a time is what I always communicate to clients, because, right now, rates might be higher than they were last week. And then we run the numbers for a particular property, which we're going to crunch the numbers together with the client each time that right home hits the market, right? If at that timing the payments feel comfortable, I think that's the sign from the universe that they should proceed with offering. And after offering and getting an offer accepted, they're still not committing to buy the house yet. We have those contingencies for a reason. So I remind everybody all the time that at the time you actually have an offer acceptance, we're going to be able to secure and lock in a rate. You know exactly what payment you're committing to, what the insurance payments are, all the numbers get finalized. Then you're ultimately making that final decision if you want to proceed with purchasing.
So for some of these people, like there's a lot of people that refinanced during COVID and got these 2 and 3% interest rates, but they're not in their forever home.
Yeah.
So what advice do you have for somebody like that is planning to upgrade to like a bigger home? How can they creatively get there?
Yeah, this is always a tough question, but I still understand that going from a 2 point whatever percent to 7, 6.8, whatever it is at the time, it's a tough pill to swallow. And the one question I do oftentimes get is, can I pull equity out of the property and use that as a down payment for the next? And my advice on that, it really depends on each situation, because a primary first position mortgage on your move-up property, that's a lower interest rate. It may have made sense to actually have a higher loan amount here with a lower rate, and overall it ends up being a lower payment because, again, the home equity line of credit have the higher rates due to it being second position. So depending on how much you're looking to take out, I don't always recommend the home equity line of credit route. And I think the most important thing is laying out every option so you can tangibly, numerically, that's why I like numbers. It's very straightforward, right? What's actually saving you the most money? Mm-hmm. And then ultimately it might actually make sense for the long term to sell that property and move that equity into that next purchase, depending on how much of a bridge you're trying to gap.
The risk is that rates come down and then real estate prices go even higher.
Exactly. Yeah. Because right now, like you and I both know, like with the supply levels and the demographic household formations actually continuing to go up right now, like there's unfortunately surprisingly no room for the home prices to come down, especially here in Orange County. Yeah, they forget about that part of it. The more you wait on that move-up purchase, the more equity gain you're losing out on. But I think, bottom line, like I mentioned, we need to lay out the options clearly, and I think that usually helps people make a decision quicker. And I think not enough people, get to the point of even having that conversation to figure out those options, because you're not committing to anything by talking to a lender and going through those options and what the numbers may look like.
If by waiting, are you getting closer to your ultimate goal and getting the house that you want, or is it getting farther away and further out of reach?
Exactly.
Yeah,
and an appreciation rate of 5% on a $1.4 million property versus a $700,000 value condo they might own currently. I mean, that home's getting way more expensive way quicker.
Yeah, makes sense.
And so things to consider.